Step back and see the macro and digest it down to the micro. Trading, investing, and geopolitics from macro down to the micro. Welcome to Macronomics.
Welcome back to Macronomics, guys. Today we are talking about a strategy that we are employing that we're pretty excited about the more we can tweak it and tune it. So with that, let's go ahead and dive in. So first off, guys, let's just go ahead and start off by just giving an overview of where we're at in the market. So we've been doing a lot of studying as of recently. We've been really diving into Wikipedia, so much so that we actually decided to donate some money to the cause just because we feel like moving forward, Wikipedia it's such a wealth of knowledge. And, yes, there's sources that you need to be able to think for yourself and not take everything as is, but just the correlation of information is vast. So we've been diving into interest rates and whatnot, and so now we're just starting to see the correlation around the Fed and raising interest rates, and what that means for the economy. Supposedly, raising interest rates is supposed to bring demand down and allow any speculative bubbles to not bust. And if you have low interest rates, that can create bubbles within the monetary system. So we've just been piecing that together. The Fed chair, Powell, I believe, yes, that's how you say it. He just gave a speech, and essentially, I was at down in Wyoming, and it was essentially, everyone talking about hikes and correlations and what the Fed's going to do. And really, as we move forward, guys, everyone's looking to the Fed, but I feel like that's only one part of the puzzle. Like, they don't control what people do. They can try to influence. So I would just definitely keep that in mind as we move forward, of putting that macro to the micro. And so we've been very cautious, but also attentive, because we've been wanting to see if we can take these opportunities currently in the market. And so we hopped into two trades, one around the euro, one around the Aussie. And specifically, both trades didn't pan out. Primarily, we feel because we weren't patient in our approach. We actually set a target for the instrument to reach before we decided to evaluate an entry, but we actually decided to get in beforehand, and this is where we think we developed a new strategy. Well, I guess it's more like a strategy / tactic. So what we have been trying to employ is simply, let's say you have a 30 pip stop loss and a 50 pip stake, or to make it simple, a 30 pip take profit, right? So your stop loss, let's say you're at a point one, right? So that's $30. So you got a $30 stop loss one way and a $30 take profit one way. Now, let's say you set a target for a range within, now remember, this is example. This isn't exact pip value. This would, correlate to whatever pip value you use. Same here. I'm just using this to help us explain. So you got a 30 pip stop loss, a 30 pip take profit pip value. So what if, when you get to, let's say, the upper band of the stop loss, let's say it's like between 20 and 30, right? Between 20 and 30, now you add on to the position another pip value. So now you would essentially lose, so it's 30, you get up to 20, so it'd be 40, right? You're at 20. You're at the upper band of your stop loss. So if the trade goes all the way to the stop loss, you'll lose 40, right? Or would it be 30? Because we're adding another pip. Yes, it would be. It'd be 40. So you're at 20, right? Let's say it hovers between 20 and 30. And then when you entered at that 20 pip stop loss, and then you go down to the 30 pip take profit. So you was at the 20, around the 20 range pip size, right? And for anyone who doesn't know what pips, I'm correlating this in the foreign exchange market. So we're at this range. We've upped our pip value because we feel like we can stay in this range. So we're risking $40. Now here's where it gets crazy or a little saucy. So if you make it down to the take profit, if you're able to make it down, so you have two take profit, right? I mean two pip size, a 0.02 or a 0.2. So if you make it down to the take profit, that would be the 20 pip, which is 40, plus the $30 plus the 30 take profit. So that's that would be 60. So 60, 40, that's 100. That's 100. So you risk 40 to make 100. So here's why this is interesting. We're going to continue to improve and improvise on this. Is because if you can identify a range that, of course, you don't just hop in, and our strategy won't just be hopping in and placing these, but instead, if we can do our analysis beforehand, set our targets, correlate the fundamental, correlate the technical, and we see that, okay, we see this range, this is what we're going to do. If it reaches this, around this area, then we'll up the size of our pip value. And the reason why I think this could be great is because you could improvise with the trade. So you're minimizing your stop loss, because if you was to just load up on the point two pip value size, then you would lose 60, because the 30, you got the 30 pips, you got the points to that 60, and the profit would only be 60, right? But here's how it's great. You made you're risking, or you're minimizing your risk. You're taking $20 off your risk, and you're upping your you take profit. So the example we just gave, $40 to make 100, when it was the same trade initially. Now, of course, guys, you got to definitely adjust and maneuver with this strategy. This isn't something that is cement, so to speak. It's not. You can't be rigid in this approach. You have to be adaptable. But what I love about this strategy, and as we move forward, at least what we're employing, is strategies that can adapt and has agility, because the market is not rigid, as you know. Whether you're trading equities, you're in the bond market, or you're in the foreign exchange market, it's not rigid. There's things that happen. There's innumerable variables that correlate and connect. And the more that we can minimize our risk and expand our profit, I mean, that's the name of the game. You're minimizing your risk. It's a probabilities game. I love Mark Douglas's book, Trading in the Zone. I need to read that again, but the whole premise that I get from it is simply variables and probability, but primarily probabilities. And so, yeah, this is gonna conclude today's episode around that range, guys. I don't know what to call this strategy yet. Maybe this already exists, but this is just from my personal experience of trading and learning from my experience. And I mean, I just broke it down. You think about it. You had if you was to go into the trade initially with that pip size value, you would be risking 60 to make 60. But if instead you want to trade that initial 0.2 pip value, and you decide, let me start at this, and if we can get to this range, so boom, if you're able to get to the range, you've minimized your risk by 20, and you've added $40, so you've doubled your profit, and you've cut your risk by a third. That's great, guys. It's the math and I guess the science behind is what's very intriguing for me. So we're gonna continue to play with this strategy. Stay tuned, because we got a lot coming. The website will be coming soon. We also got we just got a lot planned. We're just gonna keep you guys we're going to keep you guys updated. We're going to continue to keep learning, putting it together, bringing the macro to the micro. And until the next one, guys, just keep putting it together.